All right, Ben, we're going to dive in right away with a really sinister start to this podcast. So Ben is extremely famous in the stocks and investing space, and he's absolutely incredible. I know so many people that have directly worked with Ben, and the returns are incredible. It's absolutely amazing, but he's also the person who very publicly says that he believes there's going to be like the mother of all crashes within the next 5 years. Mm-hmm. So I'm really interested from your point of view, before we go into how you're going to navigate that now, 6 months from now, a year from now, 3 years from now, 5 years from now, and all the catalysts and things like that. Like, why do you think there's going to be the mother of all crashes in 5 years?
Great question. So I think I'm looking at like a 3 to 5 year timeline for this. No one knows when this crash is coming. Okay, I just want to make that super clear. Anyone who says, it's going to happen at this total
happens before this episode goes out in like a week.
Yeah, that's going to look great, isn't it? Yeah. But the reason I think big indicators, I'm a big fan of looking at who's the top people in the world. What are they thinking? How are they acting? Now, people like Warren Buffett. Warren Buffett's been liquidating his assets for a long, long time now. And I think he's in something like $320 billion of cash, but like sitting there ready.
Yeah.
Now, that's a pretty good indication. Yeah. Under the mattress kind of, that kind of thing. So yeah, Warren Buffett's been doing that. Ray Dalio, he's been predicting it's coming. I saw Jamie Dimon, CEO of JP Morgan this week, talking about he's like the most cautious out of everyone. Like he's like, this is going to happen. So when I see the people at the top of the industry, the most intelligent, most successful people saying, Frank, like, I think this is not only saying that they think it's going to happen, but they're acting on it. Mm-hmm. I think I'd be a bit silly to ignore that and think, it's not going to happen. So that's how I take my biggest sort of signs that that's going to occur. Now, obviously, you say stock market's gone up, it's overinflated, blah, blah, blah. Yeah, sure, that always happens. But people always say that. The stock market has gone up like 40 out of the last 50 years. Mm-hmm. It's 100% of the time after a drop gone up higher. So it's very easy to be like, it's at the highest ever, it's going to crash soon. That's just how the market goes. And people like Robert Kiyosaki, I think he's been saying it for the last 15 years. The biggest crash ever's coming this year. No, this year. No, eventually he's going to be right. So I don't worry too much about what the market looks like. It's more about how the big players are acting. I think that's quite a cool way to approach it.
Yeah, I've seen all that with Warren Buffett, and he's always getting hammered with why are you liquidating Apple stock and all of those things, and he's always talking about sitting on so much cash right now because he hasn't seen the opportunities, and he would love to see the opportunity, and he was like, I'd invest 100% of it right now if the right opportunity came up. But even with somebody that feels like such an amazing human being, you wish he was like your grandparent.
Yeah.
On the other side, just when people are playing at that level, I think you have to sort of think, why might they be saying it at times as well? Yeah. Like, because they have, like, he's got shareholders, and they need to know that he sees a positive outcome of such coming in the future.
Of course.
Ray Dalio, like, every time I see a video from him, I, like, put my hand over my eyes, and I'm like, I feel like I have to watch this because of what you're saying, because all he talks about is like the worst happening and diversify into 15 different industries. I barely know how to navigate 2 industries. Like, how am I going to go into 15 here? Yeah. So what are you doing with that information? Like right now, are you 100% invested? Are you a percentage invested? Like how are you navigating that?
So I'm quite strange in how I approach investing, in the sense of, yes, I'm knowing that that's coming, or I think I know that that's coming, but I won't necessarily react until it is happening. And what I mean by that is a lot of people, so people like Warren Buffett are liquidating, getting into cash, which is awesome. But you've been doing that a long time now. The reason being, he has so much. You can't just pull 320 billion out of the market. Like, you can't just click sell and it gets in your account. That's not how it works at that level. So he has to do it gradually. As individual investors, as much as we'd love to have that sort of money in the market, it's like you're a lot more liquid. Like, you can make a decision in a day and be out and cool. So for me, rather than being too overly cautious that, there's a crash coming, I better not put my money in, I wait until there is signs of, it starts to drop and you can sell and then act on that. However, what I have done, I've probably got 25% cash at the moment. Weirdly, based on what you said, funnily enough, because of the lack of opportunity of what I want to invest it in. I will never jump into the market like if there isn't a good, just for the sake of it. I'll wait until it fits what I'm looking for perfectly, and then I'll get in, regardless of what the world's telling me in the newspapers and whatnot. So I guess similar to Warren Buffett, like, and when he says, I'm waiting for an opportunity, he does mean a crash. Let's not, because that's the other thing. People hear crash, think bad.
Mm-hmm.
Investors, good investors, hear crash, think opportunity.
Yeah.
Which is what it is, right? Because
Yeah.
if you were, in a real way, if you were prepared to buy something at this price and overnight it drops 30%, you should be delighted.
Yeah.
It's on sale.
Yeah.
If it's a good stock, a good asset, that's great. Like if you were saving for your favourite car, I don't know, and you've been saving, and then one day they have a 50% sale, you'd be like, oh my God, look, I'll take two, like you'd be so happy. But people see a stock drop and they're like, ooh, that's a bit risky, I don't do that now. It's an interesting mindset.
Yeah. So what are you seeing are the opportunities right now? I've only seen like two, but I'd love to know your point of view. And I'm talking about like borderline individual stocks here.
Sure.
But like go for it. Like you can talk macro, individual stocks. Like what are you seeing as opportunities?
Probably the two most recent one. Well, the most recent one I got into maybe a few weeks ago was actually Microsoft. And interestingly, it's not because it's like dropped a lot. I think it dropped maybe 10% when I got into it. Not because I got like, new products coming, nothing like that. It just happened to fit exactly what I was looking for at the time.
Mm-hmm.
Like, so as you know, how I invest is very like black and white. It's very much like, does it meet the criteria, yes or no?
Mm-hmm.
And if it does, I invest. If it doesn't, I don't. Like, I keep it that non-emotional, which I think is probably good advice for anybody to remove emotion. But yeah, it just happened to fit what I was looking for. Now I could look at that opportunity and think, right, second biggest company in the world, probably about 4 trillion at the moment size, maybe overinflated. Like maybe that's a bit risky to get into. But again, if I'm just panicking and being really cautious because I think the market's going to drop any day now, I'll never get into anything.
Yeah.
Like in the meantime, there is money to be made. Like being cautious because a crash is coming, mindset-wise, okay, but I don't think money-wise you actually need to physically be that cautious at this stage as sort of the level of investor we are.
Mm-hmm. Yeah. See, what I struggle with is, and I'd love you to speak to this mindset, is so I have like a target for my year.
Sure.
And I usually hit that target by like 6 months or 7 months or 8 months in. And so I go from being somebody who's quite bullish. And then as soon as I hit my target for the year in terms of percentage return of what's fully invested, I can then start pulling more out and being like, well, if more's in cash and like it still gets like a monthly return in money market accounts and things like that, then I can only really yield upwards. It's not going to be a great return from here, but I've kind of hit my target for the year, like outpaced S&P and things like that, so I'm done. Great. What do you do around that mindset? Are you just kind of like, do you look at the annual as a target, or do you just look at like the next thing in front of you as the target?
Very interesting. I like that strategy as well. That is cool. It's nice to have that. I think I've always found, and obviously you do disagree with this, but setting investment targets, I've always found a little bit counterproductive for me. And the reason I say that is because of time. The one thing about investing is you have zero control over the time frame of things. Like if I buy Microsoft, I don't know if tomorrow it's going to go up 10% or if in 3 months it's going to go up 10%. I have zero control over it, so what will be, kind of. So I found that when I have set time targets, I either exceed it or don't hit it, and then I'm like, well, I followed my strategy, like I had no control over that. So it was almost a bit like, what's the point? Because I'm happy if I hit it, I'm not happy if I don't hit it, but because I couldn't influence it,
Yeah.
I'm like, hang on, I can't be happy or sad about an external thing that I have no influence over.
Yeah.
So I've always found them not good for me personally. Now, I think a lot of people talk annually for the reason you said, like having that sort of growth, you can see it building. How I've really done it, I like to see it like investment per investment, like as in, okay, well this one, how is it doing? And I separate it totally mentally from everything else I'm doing. Because I think if you treat each one as its individual case, individual investment, I think you make a lot smarter decisions. Good example would be, let's say you were not hitting your target for the year. You're like, God, I need to make this extra 10% before the end of the year. You're probably going to make some bad decisions, some rash decisions, a bit more like, oh, well, let's just put money in here, let's see what happens. And that leads to mistakes. Equally, maybe if you've exceeded your target and you're like, well, you know what, like, who cares? I already hit the target, let's go for a riskier one now. Again, could lead to mistakes. So if it works for the individual, perfect. Because I know some people love to have that structure. Just for me though, it's never actually worked in that way.
Yeah.
Which is a bit different.
I love it that you think that way, and that's already making me feel like different about it. More from the point of view of what hasn't really happened thus far, but it can easily happen if the crash that you talk about will 100% happen, is if you haven't hit your target for the year yet. Which I've obviously been pretty lucky the last few years, as a lot of us have, that not all companies go up, but market has performed very well in the last 3 years or whatever it's been. And so that makes it, I say to Adri all the time, I'm like, this is our returns over the last 3 years on average. And she's like, oh, that's brilliant, it's great, da 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 da. And I'll say, but albeit that, I want to share this with you because I share all financials with Adri, we're married, by the way. So I do that, but at the same time I say, but by the way, I could easily lose it all. But I don't expect to lose it all because I've got a certain allocation to things like S&P. I'm actually in, a lot of cash right now as well. So I don't expect to lose it. But in the same way that you can get a 28% return over the year thus far, in the same way, next year might be down 14%. Yeah. Or it could be if it's the crash you're talking about, and a lot of people are talking about it being bigger than 2008 when it does happen. And I suppose the longer that it doesn't happen, probably the bigger the crash is going to be. There's going to be those years where it comes down. And so the 28, last 3 years, I think I'm on, for my retirement account, it's 28.3% average return for 3 years. And the brokerage account is in the sort of mid-30s or something. But one bad downturn and that changes right away. And so do you look at stats like that? Do you look at long-term returns? Or again, are you just completely detaching yourself from anything other than the next one that's in front of you?
Interesting, because I've probably not realised I do this until you've just phrased it that way. So I use the annual side of things as a bit of a scorecard. I know we both love sports, that kind of, so it's a good way to keep that. I just think that's our nature to do such a thing. But equally, I would never ever let my annual, whatever percentage, whether it's good or bad, influence my next decision. So I do take it one investment at a time. I guess it's kind of like football. I know you love football. A team has to play the game in front of them. If you're thinking about a game three matches down the line and your head's not in this one, you're probably not going to put in your best performance. So I kind of treat my investments the same. It's this is my main priority right now. Who cares if I've had 10 stupid ones in a row? This one is the one that actually matters, because I can't change what's happened.
Yeah.
So I find detaching myself from it that way, it really, really works well.
That's class. And if we were to look at asset allocation, right? And I think when we spoke about this a few years back, when we first met, I think you were borderline 100% into individual stocks, way you teach, etc. as well. Each individual company has value or it doesn't have value, so it's a good investment or not a good investment. How has that changed as your wealth has gone up? Have you had to take a closer look at asset allocation and things outside of individual stocks?
Interesting. So fundamentally, exactly the same approach. The strategy you were talking about, I still follow that every single day of my life. I will till the day I die. If that ain't broke, don't fix it, kind of thing, right? So that's that. However, one thing I have done as my wealth's increased, I've made a big differentiator between investment funds and storing funds. Now, I've said storing, not saving. Maybe we'll get onto the topic of saving soon. Because having money aside that isn't in the market, isn't in individual stocks, and it's your safety pot, if you want to call it that, or maybe it's a stability fund, however you want to phrase it, there is value to that. And when you get to a certain level of wealth that you want to have that side, I think it's smart to do. But what I do now, I have all my investments in individual stocks. Money that I don't have in individual stocks, which some people would put in a bank. Personally, I think savings accounts are one of the biggest scams of the 21st century. We'll touch on it now. So I wholeheartedly disagree with leaving a lot of money in the savings account. Now, there is something to be said for having an emergency fund, maybe, just sitting there safe. The reason I disagree with savings accounts is purely because your money's losing value. Right? We all know inflation, if it's higher than the interest you're getting in the bank, in real terms, your money's losing value every single year. And real inflation, I don't know what it is in Florida or what they tell you it is. I'm not sure. But in England, it's always like, it's 2%, 3%, 4%. No one can tell me that if they look at their grocery bill from a year ago, it was 2% less or 3% less. Things have gone up loads. I do believe true inflation is double figures.
Bacon's up like 32% here.
My eggs, right? Honestly, this really.
And I eat a lot of bacon.
Yeah.
So this is a problem.
Yeah, well, a 12-pack of eggs in Tesco, it used to be like £1.80. Let's say 3 years ago.
Yeah.
£1.80, £3.80 now. That's more than double. Like that's great. That's not 2% inflation, is it? And I know that's like a silly example. We're laughing, but that's what you buy on a daily basis. So those sort of price increases are actual inflation to you as you don't care what the price of I don't know, tables have gone up. That doesn't matter to you, but actually your day-to-day purchases, that really does matter. And so anyway, a slight diversion there, but real inflation I think is at least 10%. And the way I look at that is then you need to be making at least 10% of your money just to stay still, just to stay even. And I don't know any bank account that's offering 10%. It's not, right?
No.
1% if you're lucky, maybe 2, 3. So just leaving your money in the bank means that even though the number's not changing, not going down, what you can buy with that money is going down, which is really a bit of a silent killer, I think, for a lot of people. But they call it a savings account, so people think it's safe.
Yeah.
I always say, if you were let's say, however many hundreds of years ago, you were working in the bank in the marketing department, and they come to you and say, how can we convince people this product is safe? What would you call it? You'd probably call it a savings account, right? It was a smart marketer that did that. So yeah, I don't agree with leaving a lot of money in there for that reason. But what I do for the money that people would save, I call it storing it, because I put it into things like the S&P. I put it in things like Vanguard funds, because they do average 8 to 12% a year. Let's call it 10. So you are doing, and for you to lose money in that, all the companies would have to go bankrupt overnight.
Yeah.
And if that's happened, I'm probably not worrying about my stocks, right? We've had alien invasion or something that's happened. So I feel that's very safe because, it's going to fluctuate throughout the year. But if I'm not taking it out, who cares?
Yeah.
It's when you take it out, that's what matters the figure. So if it's increasing, let's say on average 10% a year, you're doing way better with that than you would leaving it in the bank. And to be honest, I trust the biggest companies in the world more than I trust the bank to look after me, personally.
This shows our risk tolerance that For me, I still see S&P as it's certainly not where I got the returns of the last 3 years, right?
No.
But it has way outperformed the 10% because it's been on a bit of a tear, which is probably why the crash is coming. But for me, it's I would say I'm probably actually not right now, but just take it back 3 months even, and then 2 years back from there, continuously, I've probably moved all the way into 60% stocks and 35% into indexes and 5% just in money market accounts, annualized 4.5%, whatever, and it's it's there for opportunities. But that that's kind of moved where in the last 3 months, I think I've ended up 45% cash, as in in money market accounts. And part of it's the annual thing, being right, I've far surpassed what I'd hoped to earn this year through investments. And then the other thing is just all this PE ratios are the highest they've ever been. S&P is so overpriced. We're one bad bit of news. Trump is one announcement away from something to scare the market,
which we saw on Friday.
Yeah, and so to be fair, I don't just do it with I don't do it with nervous energy. I do it with excitement. And so I don't know if you just saw Friday there when the markets crashed in the after hours and everything. Bitcoin went down 13%. I'm sitting there. I looked at my phone just passingly. I saw Bitcoin down 13%, and for me,
bye.
Most people are that would be panic moment. Yeah. Me, Adri, and Luca are in this kind of area here, and I was I need to see what's going on. And then I opened up the laptop and I was it actually is down 13%. I was bought a load of Bitcoin, and then we literally bathed Luca. Put him to bed, and it went from 13% all the way back to 6.5% down. Yeah. And she was "How much did you just make in the last hour?" And I was
"Yeah. We did all right." Yeah.
And so when I take money out, like it could look, if you looked at my allocation, you would be like what are you, like an oligarch or something? like just trying to like preserve wealth, which isn't the case. But it's actually because I just feel like this administration can like can cause like 35% drops.
Yeah.
And when it happened at the start of the year, I was like in an Uber on the way to Disney with my family here, and I was like, this is so great. Like I've just lost like 200 grand, like on paper, but this is fantastic.
Yeah.
And I was just like, as much money as I could get into it, I was just like piling back in. So it probably looks like I'm really negative, but it's actually because I'm looking for opportunities.
Well, that's it. And I think having cash in your stocks account, and I get this with my clients, they're like, oh, but it's wasted sitting there. Like, I want to put it into stocks. And I'm like, well, if there's not a good opportunity, keep it in cash because that's potential. You've got to see that as potential. Because when there is an opportunity, then you can take advantage of it. If you're fully invested, you can't.
Yeah.
Right? So there's a lot of power in having that cash sitting there. Which, as I said, I've got, let's say, 25% cash ready. And when there is a big drop, even if it's one stock drops and has a bad day, happy days, like you said. Like, Bitcoin's down, cool. Let me take advantage of that, or a certain stock doing it. So, yeah, I think it's cool, man. But you have to have that confidence in what you're doing, that I'm going to invest in something that is dropping. That's not a human nature thing to want to do. It feels a bit scary, which is why all investors, they start investing at the top of the market, right? That's where they, because it's been going up so long. Worst idea, obviously. So over the years, you've built that sort of tolerance, that experience to know that a drop in a good thing is a positive thing, right?
And so what's on your Apple Watch list right now that you're like, every time I open it up, I hope I see some red so that I can like get some opportunity here? Like what's on there?
I think I've probably been saying this like 12 months at NVIDIA. I love NVIDIA.
Right now?
And still, so I want this big, like, that would be...
If it goes down 35%, you're like...
When it goes down with this big crash, I'm going to be very happy, let's say. I think it's incredible. It's one of... Well, I can't remember it. So I've been investing in stocks just over 10 years now. I've never seen a company with such strong fundamentals, ever.
Yeah.
It's so unique. I'm not saying everyone should pile all their money into it. That's terrible advice. Don't do that. But when it does drop, I think it's such a good opportunity.
Yeah.
It's such good. I can't wait.
It's so funny, like with like the last few earnings, where it's like year on year, like 55% growth, and like the stock goes down 3%, and you're like, like the level of expectation around this company is absolutely insane. But it's how many times do you think you've traded in and out of NVIDIA?
God, I think it's been because I'm in. Just to be clear for everyone, I don't like trade.
Yeah, it's not like minute by minute.
No. So I'm in positions for like months at a time.
Yeah.
But probably this year I've already done like 3 times in and out of NVIDIA, and they're a few months at a time each. But they just, when it drops, I'm buying a set amount, then it rises ridiculously as it does.
Yeah.
It's just a fantastic one. Now that doesn't last forever, obviously, but it's the biggest company in the world. It's fundamentally incredible, and I really like the business. It sounds a bit silly, but I do like what they do. Like, you probably heard about their staff. The percentage of their actual team, they're all millionaires now because of how well the business is done. They had stock options. Like, I think that's an incredible thing.
Yeah.
That it's I really like that about them.
Yeah. And if we were to completely flip it from, hey, we're talking about if you've been investing for a decent chunk of time and individual stocks to go into right now, which I'd like to come back to actually and ask you about a couple that I'm watching.
Okay.
Because we did this last time.
Yeah.
And I told you the ones that really didn't go right also, which is still like the worst one ever, Peloton back in the day. I actually, don't tell me that the stock's like exploded because that'll like, make me cry. But if we were to talk more from like whether somebody is like they've never invested before, or if somebody is like they're still in their sort of infancy of like they're toying with it, they feel like they're learning, they're quite nervous about it. Like what's your advice for starting? Like somebody's sitting with 3K or 5K or 10K that they've saved up and they want to get involved in investing.
Yeah.
What's your like next 3 steps or 5 steps?
Cool. So something I have to make really, really clear, and it's something that people fall into this trap all the time because they want, like, someone's like, oh, what should I invest in? What should I invest? and you give them a suggestion, let's say I just said NVIDIA, knowing to buy something is one thing, that's cool, but knowing when to sell is very, very important, as you know. So the biggest thing that everyone has to have is a strategy. Like, I will say that till I'm blue in the face, that strategy is everything. It just is, because if you always know what to do next, when this happens, I do this. When that happens, I do that. If for whatever reason that happens, I do this. Having that structure increases your likelihood of success by a ridiculous multiplier. Because if you don't have that, you're gambling. Let's be real. If you're just buying things for the sake of it and hoping it goes up, that's gambling. So having a strategy in place is essential if you're going to invest in individual stocks. Now, back to your original question of, like, if someone's starting day one, like, what do they do now? Cool, go and learn a strategy. But while you're doing that, things like the index funds, they're okay for getting into it. You know, as I said, I don't treat them as investing, to be honest. I just treat them as like a savings alternative. So do that anyway. You know, no financial advice and all that, but you should have some money in the markets, in my opinion.
Yeah.
Doesn't necessarily have to be just the S&P. There's things like Vanguard. They do the Vanguard Life strategy. You might have heard of it. It's like a fund of funds. So within the fund itself, they've got all these different things. So you're very, very spread across the world. I think that's a really good idea. And then while that's building, then you can go and learn how to actually do this properly, right? Get some knowledge, get a strategy, whatever it may be. Anything other than that, I think is too risky. Because rule number one of investing is don't lose money. Yeah, Warren Buffett says. And then rule number two is to remember rule number one, right? But so just jumping and buying things is super risky, and you will lose money doing that. But hopefully if you learn a good strategy, that at least increases your probability by a lot more.
Yeah.
So that's where I would personally start. And you can do it super easy. People think it sounds like quite a big thing getting into all these S&P you can literally open a broker account, have it verified, and put money into the market in 30 minutes.
Yeah.
You know, like
Literally did it with Adri a few months ago. Literally just she was like, we've been talking about this for ages and we haven't done it. I was like, literally just open your laptop right now.
Yeah.
And it was literally like ID verification. She was connected to bank account. The money moved instantaneously, and then it was there. And she didn't even put it into anything initially, but because it sat in a money market fund, it like 20 days later or something, she was like, I just made like $180. Yes. I was like, yeah,
that's how it works.
That's what will happen if you just leave it in the money market fund.
Yeah.
So yeah, no, that's definitely great. But you taught me about that when we were a few beers in, after maybe the first event that you came to, maybe like 2.5 years ago or something. I remember we were in Glasgow, and you were telling me, like, I knew the concept of like a stop loss, but you were like telling me like the importance and like scenarios and things, because I was like, oh, but you know how stocks go up and down? Could it like sell the stock and then like spring right back and I miss all that upside? But you were talking about more from like the point of view of like, but when it goes up, then you like reset stop losses and different things, so you have a certain window for what may actually be more of a crash than a dip, which has been brilliant for me. On that, for people that do a decent chunk of this, and for me being selfish with this episode as well, this is more like a coaching call, right? This is literally just implementation on the other side. You see when you set stop losses, you see when it's like a Trump tariff, this, that, the other, and it's like a big bang and stocks fall. Do they still always trigger? Or can it be such a trigger downwards where there aren't buyers available that stop losses don't always save the day?
Interesting. So for anyone who listening doesn't know what stop loss is, it's basically a safety net, right? So you can say to the broker, like, if the price falls to this, sell my shares. I don't want to be in this. Stops your losses. That's the idea. But as you're saying, we typically use it to lock in profit, right? So when you're in a certain amount of profit, rather than clicking the sell button and being like, oh, that's enough profit, which, what does that mean? You set a stop loss. You're like, okay, cool. Well, let me lock in this, and if it hits it, cool. I'm happy. I've got my profit. If not, it keeps going up. So you can keep bumping up that stop loss. That's the idea, which is what you're explaining there. Is there a case where it might not operate? There could, if there is such a dramatic crash or a gap. Gap's actually what causes the issue. If your stop loss is here and the market goes from there, Trump says something and then it gaps to there, the price was essentially never in the middle. So like it's there and then instantly there. So the broker physically couldn't sell it there. So they'll sell it at the next price that it could. So it can happen. What's good is that kind of gap only happens overnight. It doesn't happen during the day, right? It's like when the market's open, it doesn't suddenly, it's run in and then bam, it jump. It doesn't do that. So overnight when the market's closed, so if you're in the UK, so if you invest in the US market, which I do only, the market's open from 2:30 p.m. till 9 p.m. UK time. So if any time in the morning you hear Trump said something or there's some news, you can just delete your stop loss, right? Because if this market's closed, it's not going to do anything. So you just delete it, and then when the market opens and it gaps, you just continue with your investment. So you've got that flexibility, which I quite like.
Yeah.
If for whatever reason I didn't see that, let's say I was on holiday, I wasn't checking it, and it gapped below, you know, how we set the stop loss means you're already in profit. So if it means that instead of making 15, I make 10%, I'm like, oh, well, you know,
yeah,
I can live with that. It's not the worst.
Do you have a percentage of your overall portfolio that you put into an opportunity when it arises? Is it like 10% is like the asset allocation to new opportunities, or do you sometimes see an opportunity and go, you know, if 45% is in cash right now, 45% is going into it? Like, do you have...
So I keep life really simple for myself. I like simplicity of investing. So my rule is I split my portfolio in 5. 5 stocks is the maximum I have at a time.
Love that.
Okay, because people think you need to get into more and more and more opportunities to spread your risk. Now, mathematically speaking, that's not necessarily true, because just buying more companies doesn't mean you're spreading your risk. You're just having risk in more places.
Yeah.
If that makes sense. It doesn't lower your risk at all. So, like, for example, if you had no stocks and I said, Neil, go and buy 50 stocks right now, you're going to make some bad decisions. You're going to pick some really good ones, some bad ones. It's going to be a mess. Whereas if I said you can only buy 5, you get a chance to be really thorough with what you decide on, really picky. I think Warren Buffett actually probably influenced me with this. He talks about the 20-hole punch card. And the story goes that he said to his team, if you had a punch card with 20 holes in it, you could only ever make 20 investments in your entire life, you'd all be millionaires. Because you would be so detailed on trades, you'd pick the best of the best, wouldn't you? You wouldn't pick any risky ones. And it's true. Like, it's a really good... Now, 20 is a bit extreme in your entire life, I think, but you can see why that works. So I only have 5, and I split my capital evenly across them. So, for example, if you had £5,000, I do 1,000 in each.
Right.
To keep it nice and simple. And what it means is, I see why people do have more in certain ones than others, cool. But I've found, if I've ever said, this is going to be a real winner, this one, I'm going to put more in it, I'm always wrong. And if I say, I'm going to put less in this one, because, you know, it's not much, it will do well. You know what I mean? Like, you're always wrong. So, by keeping your capital even across them, it actually doesn't matter to you. You don't care which ones do well and which ones don't, because you get the same profit overall. Which is quite a different thing. People don't really think like that, but it makes your life so much easier, because you couldn't care less which one's going to be the best or which one's going to be worse in your portfolio. Yeah.
And what about if let's say that you've got 3 stocks that you're in, and the rest is in cash because you've sold recently or whatever, waiting for the next opportunity, and then the 3 stocks that you have, one of them goes down 7%. Are you like, well, I already thought it was great at that price, now it's down 7%, I need to get more into this? Do you go outside of it when that type of scenario occurs?
So, this is going to come back to strategy, so I won't get too detailed here, but so how I do it, I never, like when I say I split my capital in 5, I don't then put the entire 5th into the stock at one time. I like to average into it. So if anyone doesn't know about averaging, it's about, you know, buying an amount, and then if the price drops, you can buy some more of that thing at a better price, so on and so forth. So when it does go up, excellent, great. That's a really powerful thing, by the way. If anyone's not averaging, they should be.
So this is like 20%, but it's not 20% instantaneously.
Correct.
Gotcha.
So like when I said at the start of this, I've got 25% cash sitting there. Someone might listen and think, well, hang on a minute, didn't he say he's doing 20% at a time? Yeah, it's because not all of the funds I've allocated to that investment is actually in it yet. I'm waiting for it to drop a bit further.
So would you categorize it as like a maximum then?
Correct.
Right.
Exactly that. It's the maximum I'm willing to dedicate to this investment.
Gotcha.
And what it just means is you don't have to be right the first time. Because a lot of people throw all their money in and then, well, at least 50% chance it's going to go down after that, right? It's either go up or down. If it goes up, they're like, oh, amazing, it goes down, oh, I've lost. There's no plan. Yeah. Whereas if you're averaging in, you're like, oh, I've got some more money to put in if it drops, you're already way more probable to make the profit, right?
Yeah.
So, yeah, does that make sense how I've sort of like budgeted that?
Yeah.
And then back to your original question about this. Remind me what the last point was.
I can't even remember.
I got so deep in that. I apologise.
But I mean, like going into individual stocks though. Let me know what
I remember your question. Sorry.
Oh no, hit me with it then. Go for it.
You said if you had 45% of your cash sitting there and you
Yeah.
saw a new opportunity, would you just throw more in?
Yeah.
To that one. So I wouldn't break my rules unless it fell further than I'd budgeted for. So I do it as a percentage base, per stock individually. Again, like what's the worst case that could happen? I always prepare for the worst because if you prepare for the worst, anything's a bonus, right? So if it falls that entire way and I've got all my fifth of my portfolio in it, great, like, that's what I wanted. And then if it fell further, I've got a decision to make. I can either wait, do nothing, because it's a fundamentally strong stock. It's going to come back. So cool. Or I could choose to invest more money in that if I wanted to. And for me, that's all based on the fundamentals of the company. Like I base it all on like facts rather than how am I feeling today? That was way the wind blowing. So yeah, then I might choose to Nvidia's dropped more than I thought. I would be willing to dedicate some more funds to that. So yeah, in those extreme cases, I would add more to it. But because I always prepare for the worst, or what I think is the worst, that quite rarely, you don't really get more than the worst. If that makes sense.
Yeah.
Yeah, so I do if it's a great opportunity at a really cheap price.
Brilliant. Right, give me 3 companies that you're excited about right now. Like you've already given me Nvidia, give me 2 more.
Okay, 3 companies I'm excited about. This is a bit of a cop out for one of them, but bear with me on this. Gold mining companies are doing extremely well at the moment, and well, obviously their business is gold, right? So when gold goes up, they typically go up, and gold's doing very well. The reason I say this, and like fundamentally, a lot of the biggest ones are getting a lot better as well. The numbers are looking really, really good. It's healthy. Now you might say, oh yeah, it's because gold's doing really well, which is true. But when the markets crash, when there's any sort of turmoil in the world, is the time in history where gold and silver do better. They rise in price. When things are going well in the world, gold and silver are quite boring. Like they typically are quite stable. But when there's crisis, people revert to old money, if you will, with gold and silver. So I look at that and think, right, well, the companies are looking great right now. I personally believe we're going to have possibly the biggest crash, well, definitely in my lifetime. These could be really cool, and you'd probably not worry too much if your money's in gold, like that's not going anywhere.
Yeah.
So I actually think there's a lot of opportunities there that are a bit underrated. It's a good way to invest in gold without investing in physical gold.
Yeah.
Which I think is quite cool.
Do you have any physical gold?
A little bit, which is a very new thing for me, by the way. Very new. Start getting coins and things. I don't love it as an investment vehicle.
Yeah.
I think it's a good store of wealth.
Yeah.
I want to be clear on that for everyone listening. I don't think, because, like I just said, gold goes up in value when things drop, so your money's sort of safe, if you will. But obviously you've got the problem of storing it. You have to physically keep it safe, which is another challenge, a bit risky.
We've got none in this house, by the way. Right.
Don't look under the stairs.
Yeah, don't even bother.
But that's genuine, right? Like, having gold in your house is risky as hell. Like,
it is, yeah.
So there's that. So it's a nice way to invest in gold without investing in gold, which is quite cool. I think.
A guy breaking it. I'm just thinking, a guy breaking into the house, being like, "All right, give me your Vanguard password then."
He got me there.
Unlock your phone. Yeah.
That's such a 2025 thing, isn't it? Give me your Face ID. And then third company, sorry, I will answer the question. What else do I like at the moment? What am I interested in? I am very interested in whatever I'm currently looking at. So let's say like the top 20 that I'm currently interested in. Whichever ones really get hit by this next crash, I'm very, very keen to look at. Now that's a bit of a wishy-washy answer, but the reason being, I don't get emotionally attached to a stock either. Like if I think a company looks really interesting, it's going to be good, that means absolutely nothing in the world. Like the stock market is a great way of teaching you lessons, and every time I've ever thought, oh, this is going to be, I can't wait for this to happen, because it just never materializes as you think. So, like, it could be a pharmaceutical company, it could be biotech, it could be whatever. But me knowing that, look, when these drop, like, whichever one looks like the best deal, amazing. So I've got into like a pharmaceutical company in recent times called EXEL, and I really thought it was going to pick up quite quick, and it's just been literally since the day I've got in, it's just gone like this for a month or whatever. So I'm like, well, you know, I know it's going to be fine in the end, but anytime I try to make that, this is going to be the one, just never materialises that way. So I know that wasn't quite the answer.
No,
but I want to be real. Like that's actually how I look at it.
No, that's interesting. What's your thoughts on? So, when crashes happen, my thing is to go heavy into only like 2 or 3 things.
Yeah.
But it is just almost always because actual crashes, and like when Trump tariffs first came in, that was actual crash. There was no green. In the market, it was every single thing goes down, and there's maybe like levels to that, maybe like 20% or 18% for individual stock, right down to like some things went down 60% or whatever it may be. But I, like, on my watch list have the same companies all the time and have done for years. So it's the likes of like Amazon and Meta. So like big companies, successful, profitable.
You've got an interest in like
an understanding.
Yeah.
More than anything, I think is like valuable. I bought that Peloton tread and then made a stupid decision because I thought I knew the company on the other side. So no, I'll never do that again. But yeah, so when those things happen, I never go for like the like smaller stocks. I'm always going for like the more established. Like a Microsoft going down like 18%, for instance, is like
amazing.
Of course it's coming back.
Yeah.
I don't know if it's going to be in 48 hours, and I don't know if it's going to be in 4.8 years.
Yeah.
But that's coming back and more. And so there's your like, and I think it's like, it's not, if it's 18% down to get to the same price, technically if you buy at that price, it's not 18% up, it's like 28% up or whatever the number is on the other side. So just to get back to where it was is a 28% jump.
Yeah.
Which is great. So that's my outlook in those moments. My outlook right now, and again, this is just me being selfish because I want you to tell me if it's right, wrong, do this differently, whatever.
I'll be honest.
So I look at everything and see it's expensive in terms of like PE ratios, etc. And so the companies that I really like, the likes of the Amazons, I buy them. I have bought in and out of Amazon over and over and over again. When it goes into 180 to 190, I buy, and when it goes to 220, I sell. And then I wait for it to go back to 180 to 190, and I buy, and then I sell it at 223 or whatever it is, right? And I've done that over and over and over again. I do the same with Meta, and I do the same with like a few good stocks. Right now, because there doesn't really seem to be too many opportunities in the big names, the ones I've gone for, and I've traded in and out of these 3 times so far, is Rocket Mortgages, because interest rates are almost certainly coming down, and that's always a newsworthy trigger to that stock. And whenever it's coming up to like a Fed meeting, it starts to rally, and as soon as it isn't as exciting as everybody thought, it crashes. So that's like my like back and forth right now. Bit riskier because they're not as profitable as other companies, but I feel that with your sort of mindset of you buy now, you hope that you make like 50% on it in 3 days, but if it's 3 years, then it's still 50%.
Yeah. Exactly.
So it's like you're happy to hold it. The other one is Robinhood, which I feel is a little bit more speculative. That's more of just like, they look quite exciting. You know, you could kind of see them taking over financial markets, just because of their like mindset to things is like so flamboyant and like, you know, I would just try this, where Vanguard wouldn't do it.
No.
You know what I mean?
That's quite an interesting one, Robinhood, because they've almost made it very, very accessible for people to start trading, investing and stuff. So I like that.
Their big thing is all about like tokenization. Like if I said to everybody, do you want to like own part of this house, so that when ultimately we sell it, you get like the chunk. Well, it would be very hard to contract that, etc., make it legally binding. But with tokenization, putting it on the blockchain, it's something that anybody could do, and they could tokenize their car, they could tokenize their house. People can tokenize companies that are not publicly traded companies, which is weird and wonderful in itself. And if they crack that before everybody else, I could see everybody flooding that way. And I obviously see the TV adverts here for them as well. and they do amazing TV
Do they?
adverts.
Because we don't get that in the UK.
Yeah.
Oh, dude.
So like they usually have no sound, and they're just very cinematic, and it's just an offer.
Oh.
And that's it. So it's like transfer directly from another brokerage,
Yeah.
X amount, and we'll give you 1%, 2%, 3%. So it's like you transfer $1 million, you'll get 1% on your money, which is good,
Yeah. Happy
right?
days, yeah.
Instantaneously,
Yeah.
right? I think you have to keep the money in for 12 months for that to then land in your brokerage account, but that's the deal.
Yeah.
But they have like 5, 10, 25 mil, 50 mil, 100 mil. And so they have like real chunky incentives to get that money over into Robinhood. And so I feel like there could be something really exciting there as well.
Interesting. The
But again, that's
disruptors-
not based upon any fundamentals. That's
yeah,
a feeling.
yeah.
That-
I don't actually know the fundamentals of them, to be fair, so I'll have to have a look for you.
Yeah.
Might be some good or bad news, I'm not sure. But you know, I like the thought process. I mean, I don't do any investing like that anymore, in sense of like, I really believe this is going to be the next big thing. Maybe I'm missing a trick there, I don't know. I'm not sure, but for me, I think I've got so almost boring as an investor now. It's just like, what do the numbers say?
Sounds like the best
what do
way,
the numbers
though.
say? Yeah, well, there's that. But yeah, it serves me well in terms of no emotion. If I'm wrong, well, the numbers were right, so like, what could I have done, you know?
Yeah.
It kind of removes the blame as well from yourself.
Yeah.
Because if you always followed a strategy and always followed this, then this, and this, if it goes well or bad, that wasn't you. Do you know what I
Yeah.
mean? So when there's the highs, you're like, cool. I can't get too overrelated here and make a mistake.
Yeah.
But also when it goes bad, you're like, oh, well, you know what? I followed my steps. What else
Yeah.
could I have done? But maybe I need to be a bit more finger on the pulse. Like you.
Well, I like
I'm guessing you don't have a huge portion of your portfolio in there.
Well, it was a chunky amount at the time. I'll be honest. It was a solid like 10 to 20% each time.
Yeah.
But I don't do the thing that you said.
Averaging into it.
So I'm just like, that looks great. I'm like, bang, just like throw it all at that thing and just, you know, I believe in it.
Such a marketer. Such a... Oh, this ad's popping up the
That
budget.
ad's
Like-
working.
Yeah.
50 grand into it this month. Yeah, that's basically my take. Start at £10 per day, but if it works, it's 100 grand a day, right? That's basically it. It's just maths at the end of the day. Yeah. Right. So to loop it back round to what we talked about at the start, to close us out here. So we don't know if the crash is going to happen. I actually think that like nobody knows anything with this stuff, but I think anybody with any sense would say, well, no, it has to happen. It's just nobody knows the time frame of when it happens. But what is your advice to people who are not you? Is it any different from the advice that you would give to yourself with like where your finances are, your risk tolerance?
What would you tell your mate in the pub?
Yeah,
God.
What would you tell your mate in the pub when that's not financial advice either? Yeah, what would you say between now, a year, 3 years, 5 years, if the crash has not happened, are you getting more risk averse as the time rolls on?
Interesting. So the best, not advice, is you have to get prepared now. So people are very reactive in the world. So I think 2020 was probably the year when the most investment accounts were opened in the world because stock market crashed, everyone's sitting at home bored, like, oh, let's get a trading account. Which actually was quite a good thing, I guess. But then it's too late. If you start learning and start having a plan after the event, you've missed the biggest opportunity already. But also, you're in a bit of a panic. You're in a like real deadline. You're like, oh, I'm going to need to make this work. And it's not good. Not good. So if you're prepared beforehand, like you and I probably have a pretty good idea of how we're going to behave when the market crashes. Well, that's... Yeah.
Take my money, Adriana, sell the house. Yeah.
But like that's, you know that's happening.
Yeah.
Like you know what to do there. Whereas you don't want to be in the situation where it's, oh my God, it's dropped. What do I need to panic. So for anyone, I would say get prepared now, i.e. learn a strategy, or at least if you don't want to learn a strategy, say, write this down. Literally, when the stock market drops 20%, I am going to put X amount of money into this. If it were to drop another 5% or another 10%, I'm going to then do this. Like, maybe literally write it down and then hold yourself to that. That's your rules. Because when it's dropping and you see the red, like you said, like it's all red, to actually make that investment for somebody who's new to this, it's kind of a scary thing.
Mm-hmm.
Like, it's quite hard to want to invest in something that you can see dropping. But if you've got like your set rules written out, and you're like, oh, I'm just going to do that, then that, then that, and you stick to it, after the market recovers, like you said, you're going to be laughing.
Mm-hmm.
You're going to be. So that's what I would say to anyone now. Either learn a strategy or at least give yourself some guidelines that you will follow at the time. Set the account up now. Super easy. There's so many brokers out there, all the good ones. If you're in the US, I guess Robinhood might be try and boost that stock for you.
That's why I bought the Peloton. I was hoping to try and turn that company around on my own before I sold the stock. Yeah.
But yeah, if you're in the UK, because I'm guessing you've got quite a lot of UK listeners.
Oh yeah, majority,
Nice.
probably 90%.
So in the UK, not financial advice, but advice. Go and open a stocks ISA, individual savings account. You can find any broker that offers it. People like Trading 212, Hargreaves Lansdowne, they all offer it. It means that all the profits you make are going to be tax-free. Big bonus. You don't want to be sharing your profits with the government. Right?
And that's before retirement or after retirement?
Oh, now. Yeah.
No, excellent.
Yeah, so it's essentially like a bank account. You can access it whenever you want, put money in, take money out, all good. But it just means your profit's going to be totally tax-free. You can withdraw them, spend them, do what you like. Great. Most people don't even know that exists in the UK, so it's the perfect thing. You can open that. You just need to be 18 and a UK resident. So go on a broker, let's say Trading 212, open a stocks ISA, just put some money in there, like you said. Put some money in that you're going to want to invest. In the meantime, it'll get a little bit of interest, like in the money markets, maybe some, I think they offer like 4% a year.
Yeah.
I mean, that's better than most bank accounts already,
Yeah.
so just putting your money in there and leaving it, not even investing it, is probably a smart move. And then when it does happen, you're ready. And I think that's probably a good idea. Also, now I've said that, 2020, when people were panicking making these accounts, a lot of the broker accounts stopped accepting new people because they had too much. So you don't want to be a part of that either, where they're like, oh, they're not accepting any more UK or wherever people. So yeah, get it done up front.
Yeah.
Set that up.
Excellent. And then to close out, like I would advise anybody do one of your live masterclasses to find out how to actually do this. Understanding companies, taking the thought process out of it, understanding how to limit risk using stop losses and all of those things. And obviously I know multiple people, including Joel right here, who've worked so closely with you and done great. So I'll put the link down below in the description anyway, but just in case anybody's listening on audio or whatever it may be, where would they go to find that?
Perfect. So they can go to our website, thetradetribe.com, and then on there you'll be able to see when the next one's coming up. And it's like a hour and 15-minute live session we do, and we just go through like, this is how we do it.
Yeah.
Because I quite like that, because people see it and they're like, oh, I could do that, or that's not for me, that looks boring as hell, get me out of this place.
Yeah, I'm way riskier than that. Yeah.
This guy's too stable.
Yeah.
But yeah, that would be how they find it. Thank you.
Excellent. Fantastic. Right, thanks so much for coming, my man. Really appreciate you.
Appreciate it.